Thank you, Dr. Marquez. Welcome, everybody. Thank you for joining us this afternoon. So we'll just do a brief introduction. The goal today is just to give you an education, just a little bit of information about this new tax law that passed um, last year, almost a year ago now, and what some potential planning opportunities that Jeff and I see in our industries. This is meant to be, interactive. If somebody has any questions, please, we'll be monitoring the chat. You're able to do that. You're also able to go off mute. I'm not sure if, for the recording purposes, you want to ask any questions that are too specific, right? Because it is being recorded. But I'll let Jeff go ahead and introduce himself, just because he has way more letters than I do after his name, so he deserves to go first.
Thank you.
Jeff, I couldn't fit it. I couldn't even fit it on the slide. I had to use another line.
No worries. I'm still missing some letters to complete the alphabet collection, but
There you go.
hi everyone. Jeff Neumeister. I'm a CPA, so which usually kind of goes hand in hand with what someone thinks of taxes, right? No, so although Charbel and I are going to share some pointers on the new tax law changes that went into effect last year and now. Keep in mind, the point isn't to inundate you with a bunch of like changes. Well, now you could deduct this, or you can't deduct that, or now the threshold is this and it was that. It's to give you enough information to recognize that, look, there might be some things that you should consider yourself. There might be some things you need to pause and run by whoever your tax advisor is or a tax preparer, or to look at maybe if you're using something like a TurboTax to step back and think about like, well, are there other things I should be inputting this year that I didn't input in prior years, right? And understanding the interweaving connection between taxes, which is kind of the focus here, but also how that plays into your planning, right? Long term, near term, midterm, exit planning, retirement planning, all those things, because they should all go hand in hand.
Yeah. Thank you, Jeff. Yeah, and we always tell people it's not necessarily about paying the least amount of tax this year. It's about paying the least amount of tax over your lifetime. So just to give you a little bit of background on the law, and you'll see it in the slides, the word made permanent. So in 2017, the TCJA, which is the Tax Cuts and Jobs Act, was put into place, and it was the biggest overhaul of taxes in the past, I think, like 30 years or so. And so a lot of changes that were made then were set to expire at the end of 25. And so what this one big beautiful bill did is it either extended those and quote unquote made permanent, and all that means is until the next administration or the next um, restructuring of those tax rules. And so, or they took it out. So meaning that this was whatever deduction was supposed to sunset is going to sunset. So we'll run through some just real quick facts about what actually changed, and then we'll try to also give you some ideas of what you can potentially do. Hopefully you'll get a couple of nuggets here and there to make a difference on your taxes. So, um, the tax brackets were made permanent. Again, we are in a progressive tax bracket system. So basically, when we make a certain amount of money, there's portions of our income that's taxed at different rates. So those went up a little bit with inflation, and there were some small minor adjustments to the 10 and 12% brackets. But those rates were made permanent. And then the standard deduction is another thing that got increased a little bit, and that was made permanent as well. And I think, Jeff, you see this a lot more since the Tax Cuts and Jobs Act. There's a lot of people that don't itemize anymore, right? There's no benefit in itemizing as much as it's just taking the standard deduction. Am
That,
I?
that, yeah, that's exactly it. And so one question that sometimes comes up is we take the standard deduction and then someone says, well, wait, I donated this to a rescue shelter, right? Or what about the interest I was paying on XYZ? What about the sales taxes I paid during the year? Or I had some medical deductions. And the reality is, more often than not, the standard deduction for a lot of those people that raise those questions is better than all their stuff. And you have to kind of backtrack and show them sometimes, look, if we did itemize, instead of taking, this amount, you're actually going to be able to deduct, 3 or 4 thousand less, right? We prefer to take the larger of the two. Would you agree? And there's usually no pushback from that. Okay.
Yeah. Yeah, we definitely see that. And I think from the planning perspective, one of the things that we see is the people that are charitably inclined, instead of, donating 2,000 a year or 3,000 a year to the church or charity or whatever they want to donate, there are some planning opportunities around donor advised funds where, every 4 or 5 years, you'll make one lump sum into this account, and then it dishes out every year whatever amount you want to whatever charity you want. Do you guys see is that something that you see also on the donor advised side, and maybe every 3 or 4 years itemizing, or is there no advantage in that?
There is, right? Even if someone doesn't use a donor advised fund or another kind of tax mechanism like that, just holding off instead of doing the $2,000 a year or whatever they normally do is saying, look, the standard deduction is be more than we itemize. But if we take these things we normally itemize and bundle them up in 1 year every few years, then we itemize those years, right? Because otherwise, if you take those charitable deductions, let's say $2,000 every year, and you're always below that threshold of using itemized versus standard, then those deductions, there's no tax benefit. Now, there is a benefit, of course, in donating to these causes. And I'm not advocating not to do these things that are important to society and important to you as individuals, but from a tax perspective, sometimes they serve no purpose.
Got it. You want to touch on this one a little bit, just with I think what they tried to do is they tried to take out taxes on Social Security completely, right? And that didn't go through. So their next option was to add an extra $6,000, I believe. Is that right? The exemption is an extra 6,000.
About that, yeah. And then
Okay.
also it does another thing is it kind of helps simplify things a little bit. Right,
Okay.
by having just like a larger standard deduction versus things kind of broken out in different areas.
And then are there income phase outs on that exemption? Meaning, if you were about to retire, if you were retiring and taking money out of either a pension or a 401(k) or an IRA, and that money is fully taxed because that's technically ordinary income, you might want to strategize when you take it and how much you take so that you can still qualify for that exemption.
Exactly, right? And that's where you should have that kind of open dialogue with whoever your advisor is, as well as your CPA or tax preparer, just so that you're not looking at just what you do today, because what you do today might be impacted by what they is best to do 2 years from now, 3 years from now, 5 years from now.
Yep. This one I won't touch on. Let me check the chat. But this one we won't touch on too much because there is a threshold, by the way, for the $6,000 deduction. Do you know what it is offhand, Jeff?
I don't recall what it is
I
offhand.
think it might be 150 for married filing jointly, and but we can get back to you on that. The child tax credit that was just increased a little bit, um, not too crazy. So just we can skip over that because I think there's some slides that are a little bit more important. If you have any questions, we can come back to it. Um, this is the gift tax exclusion, right? So we are able to pass, well, in 2026, $15 million each. So if I'm married, my wife and I can pass $30 million free of estate taxes to our heirs. And that kind of came up from that was supposed to sunset back to about 5 or 6 million each. Remember, this includes, life insurance proceeds, the house, and this is the gross amount of your estate.
Over
Meaning,
your
if you have
lifetime total.
what's that?
Yeah, over a lifetime, it's an aggregate. So if you gave
Correct.
somebody 5 million last year, that doesn't mean that you have 15 million left, right? It means you have 10.
Correct.
It's cumulative.
Yep, 100%. Yeah, your lifetime exclusion. And you are able to gift, by the way, this year in 2026, $20,000 without having to report it. So per person, per taxpayer. So my wife and I can gift, 10 different cousins, $20,000 each and reduce our estate that way. But, some people have higher net worths that it might take years and years to do that, and a lot of cousins to do that. So 15 million, basically allows you to pass 50 million each, and that kind of takes the advanced estate planning out of the strategies of most people. So if you have any questions on that, we can answer, but I'll move on to the next one. Thank you, Jeff. Yeah. So he answered the question.
One other item on this front, Charbel, before going to the next one.
Yeah.
This question does come up often enough where someone will say, Jeff, look, we want to give $100,000 to our niece, right? Or we want to give this $50,000 to this particular cause or a friend or whatever it is. And they ask, like, what are the tax implications? That question should really be bifurcated. There's one, what are the compliance requirements associated with that? And separate, what most people usually think of, or what are the actual cash tax consequences? How much is somebody gonna have to pay tax on that? The latter answer is usually going to be zero, right? Because there's very few taxpayers I come across, right? And other than some ultra high net worth clients I've worked with over the years, most people don't get near that $15 million threshold or $12 million threshold, what used to be back in the day. So that's not really an issue. That's not to say there isn't a consequence, right? Oh, you're going to gift, $200,000 to so and so. You're not going to owe any tax. They're not going to owe any tax, but you have to file a gift tax return, right? That's an informational reporting requirement. It still needs to happen.
Yep. I mean, here not much changes, just that the Tax Cuts and Jobs Act modification were made permanent on the mortgage interest deduction. So I can move on to the next one. This is on the personal casualty losses. This just added that governors can now declare a disaster area in 2026. This helps trigger, potential, like we all had the fires a few years ago, and our taxes were basically all delayed, right? It was you can file your taxes late given this exemption because it was a disaster area. There was some flooding in San Diego a couple of years ago that they declared it a disaster area, but it was always a question of who's determining this area or the disaster area, and this gives governors the ability to do that. All
And
right. Yeah,
yep.
good. Do you want to go ahead, Jeff?
Right, one other thing on the casualty losses that sometimes comes up. So yes, the TCJA back in 2017 disallowed people being able to take these losses, right? So somebody, say, breaks into a home and takes $10,000 worth of jewelry or other goods, you used to be able to claim that as a deduction on your tax return. And then the TCJA did away with that, right? And there's a lot of kind of up in arms, well, that's not fair, it doesn't make sense. That still exists, but that's just for those types of losses. If the loss is tied to a profit-seeking activity and someone steals whoever this activity is or steals from this activity, that may still be able to be deducted. For example, I work with a lot of cryptocurrency clients. And over the years, since it's become somewhat mainstream, all these different types of scams, right? Rug pulls, pig butchering, what have you. There's all the different types out there. And I've had countless clients be victims in various types of crypto scams. More often than not, depending on how the scam originated, if there is fraud at the inducement, what kind of investment they made and why, they may be able to take a loss, right? So, for example, someone has a crypto wallet and some ne'er-do-well individual hacks into it and takes their funds. Can they claim a loss? More often than not, no. Now, instead, let's say they have some cryptocurrency and then they transfer it to somebody saying, like, hey, invest in my fund and you'll double your money in 6 months kind of thing. And I've had hundreds of people become millionaires by investing in my crypto fund. And they go in, proceed and invest $100,000 to this individual, and then quickly find out that it's a scam. It is a scam. It is a scam at the very beginning. The fund never existed, or is fraudulent, or is some Ponzi scheme or something else. That loss they can take, right? So keep in mind that certain casualty or theft type losses can still be taken via both the TCGA and what's been superseded via the OBBA.
No, no, that's a great point. Thanks for bringing that scenario up with the cryptocurrency. I did skip, and I think I was too quick on the trigger. Let me go back to, actually, it did not skip it. I accidentally hit the slide, so I will do that at the end. But there is a another change called the 199A for business owners. And so if you want to type in the chat, if you want to hear about that, if we have business owners in there, we can talk about that, and I'll unhide the slide where there's a 20%
Me.
deduction. Okay, well, I think somebody said me. So the way that it works with the Tax Cuts and Jobs Act is, so Trump was trying to reduce the corporate tax rate, and he did reduce it from 28% for big corporations to 21%. And so in order for him to do that, he had to give something to the small people, to the small business owners that kind of run the economy in this country. And so what that was is it was through a something called the 199A deduction. And so the way that that works is 20% of your income that is derived from pass-through entities gets that 20% deduction. And so there's some restrictions as to what type of industry you have. There are phase outs, there are different parameters. And I think for us, from what we see on our side, Jeff, and tell me also next on yours, is this is the biggest planning opportunity we see for business owners because of you are able to do things to fall below the threshold that can then trigger an automatic 20%. It also is dependent on what your W-2 income. So if you're paying yourself a W-2, that makes a difference on it. But if you want to, while I unhide the slide for the more info, Jeff, if you could just touch on, the 199A and what you guys are using to kind of help plan those business owner clients.
Yeah, exactly. This 20% deduction, it's specifically targeted at smaller businesses, right? Smaller business owners, right? You'll see on the slide that Charbel's pulling up that it does phase out pretty quickly, right? So if you have a married filing jointly, it starts to phase out at now 150,000, which for a business is not very high. Now, also as the business owner, you usually have some degree of faucet control over what is being deducted by the business, right? We're presuming all of it is on the up and up, of course, right? So it's possible to kind of keep the income levels down low enough where they can benefit from this 20% deduction, which is pretty big, right? You save, let's just use a round number, $100,000 of income, 20% of it goes away, $20,000 deduction, not paying tax on a third of it, it's keeping 5, 6 grand in your pocket.
Yeah, and potentially reducing it to a lower tax bracket. Um, One of the ways that we use to bring people below the threshold is also starting retirement plans, right? So there are a myriad of retirement planning that you can do as a business owner for your own business. So that can also bring you below the threshold. Great opportunities there. We can have a whole webinar just on 199A. All right. I think this is one of the other big ones from the OBBA, right? It's the SALT tax. If I'll let you describe it, I'll add whatever kind of we describe on the financial planning side, right? But you're the tax expert on this. So how have you been describing this to clients as to like what changed and why they're getting a little bit more money back this year?
Yeah, so prior to the TCGA, if somebody lives in a jurisdiction like California, like New York, where the cost of living is pretty high, right? Between the mortgage amount, the interest on the mortgage, property taxes, all that stuff, that's quite a bit. And it used to be you able to deduct maybe not all of it, but most of that. The TCGA in 2017 really kind of took an axe to that and dropped it down to $10,000. Right. So we have a situation where, I'd have taxpayers that they were deducting, 50, 60, 70,000 on itemized deductions for these things. And all of a sudden, now they can only take $10,000. That was a big hit. Now, states, especially California, were pretty quick to react and try to develop working loopholes for taxpayers. Um,
Shockingly.
was that
I said shockingly quick to
shocking?
react, right?
Right. So, to try and help people out, especially in the states like where they live, like in California, where they know that it was really targeted towards high income states or high cost of living states. And they came up with in California it's called pass-through entity. It's an elective tax, but it was only leverageable by people that had businesses of a certain type, right? And as a way for the business to get a deduction and kind of do like a loophole sort of thing to get outside that $10,000 limit on the itemized deductions. Added additional complexity, definitely additional professional fee cost, right? Additional forms and all this other kind of stuff. The new tax law, the OBBBA, came back recognizing that, look, a lot of states are just creating loopholes anyways, and it's really to no one's benefit, really, other than maybe tax preparers and CPAs, right, to charge extra fees for this avoidable work, if you will. And they said, okay, look, we're going to bring it up to $40,000. It doesn't completely replace where things were at prior to the TCGA, but being able to deduct 40,000 without using a loophole versus 10,000, that's a big shift. Right.
Yeah. And we see that people are starting to see the difference, right? From filing 24 taxes compared to 25 taxes and seeing the ability to have that extra $30,000 deduction.
Yeah.
One of the cool things about the PTE or the pass-through entity elective tax is the fact that if you have a business, you can have the business, right, pay for your basically state income tax and
Mhm.
then get the full write-off. So
Correct.
there's
Yeah.
there's definitely advantages there. Okay, great. So next one is on the car loan interest. If you can just kind of give us a little bit of stats on it. I know that I believe it's an above the line deduction,
Mhm.
right? And so if you could explain what above the line deduction is and just some of the caveats with this change.
Yeah. So this new deduction is for think of it as kind of like where if you itemize, you're able to deduct mortgage interest. It's conceptually the same, but now it applies to a vehicle. Now, which sounds great, right? But keep in mind that there's a lot of caveats, and I think most of those are listed here as little checkmark bullet points in order to even be able to take advantage of it. So it's not as though you have a vehicle and let's say you're paying it via a loan from a bank that now all of a sudden you could also deduct that interest. No, no, no. It's not that straightforward, right? It depends on how the vehicle is being used, when it was purchased, and it must have been purchased pretty new, right? 2025 or later. It has to be of a certain weight or below a certain weight. And there's a lot of other nickel and dime things that kind of come into play. So for example, for 2025, out of I don't know however many hundreds of clients, I haven't had a single client that was able to take advantage of it where and weight made sense. I might have had a couple of clients that might have been able to take advantage of it, but the time of them getting the information, doing the calculation, all that stuff, the tax savings would have been eclipsed by the additional professional fees they have to pay in order for it to be figured out.
Yeah. And there's more check marks here, right? Final assembly must occur in the US. I like the one that it has at least two wheels. So if you have a unicycle, you can't do that. All right, so we'll skip, or I guess you already talked about this part. Next is I'd like to talk a little bit about the Trump accounts. I know there's been a lot of conversation because when the OBBA first came out, it had a lot of what we call the IRS has to then come back and give direction to what they initially said in the plan because there were a lot of things that were unclear. So what we know right now with regards to a Trump account is think of it like an IRA, an individual retirement account for your child. So the couple of additional things is if your child was born in 25, 26, 27, or 28, the government will basically give you $1,000. And I think it's a form through the tax. You kind of get like a $1,000 tax credit. Basically, they're funding it for $1,000.
But
When
it's
the
a
ch-
one-time thing.
yeah. And when the child turns 18, it becomes like a traditional IRA with all the restrictions of a traditional IRA. The
Mhm.
reason it's good at the beginning is because in order for you to open an individual retirement account for the child needs to have earned income. And so this bypasses the fact that the child needs to have earned income. There are a number of different accounts, in my opinion, that probably will do a little bit better than that. It has to be index funds. The fees are limited to a certain amount, so that's good. There's a potential for employers to contribute on your behalf into your child's Trump account and potentially not have it added as income tax. I haven't seen any companies that are doing that right now. And after 18, the kid can't contribute to it anymore. So it just turns into an IRA. Um, and then the $5,000 maximum contribution per year. So there are, and since then they've come up with, they're just starting to have broker dealers and different, like E-Trade and different Fidelity starting to open these types of accounts. There was not a lot of direction at the beginning. So if somebody has questions about Trump accounts, let us know. I haven't opened one yet. I haven't seen one in action yet. And we'll see how it goes in the next few months because they just started Q1 of 2026. And this is what we said, minimal fees. It has to track an index. And then you could always do the trustee to trustee rollover, meaning if you had it at Fidelity and 6 years later you want to change it to Schwab, you're able to do that just like you do rollovers with an IRA. All right. So bonus depreciation. Um, can you explain that? So this could be on the real estate front, because I think there's another slide for the Section 179A deduction. But I believe from what I know that this was supposed to have been coming down each year, and I think last year was supposed to come down to what, 40 or 20?
Yeah.
And so that was reinstated. Can you explain a little bit how bonus depreciation works and what the advantages of having that 100% bonus?
Yeah. So if again, this kind of applies to business owners now or future. If you have a business and you buy a piece of equipment, right? A server, construction equipment, whatever it is, right? It's normally when you buy a tangible item, right? Especially if it's more than $2,500, that's the safe harbor threshold for capitalizing expenses, tax wise, then you can't deduct that expense right up front. Like, so in the picture on the slide, you have some construction equipment. When the owner of this company buys, a dump truck for however many hundreds of thousands of dollars, they're not able to take that immediate expense right up front. It has to be depreciated. The equipment has to be depreciated over its useful life. Things could be 5 years, 7 years, 10 years, whatever. So eventually, at some point in time, they'll be able to deduct what they paid for a piece of equipment or other large tangible purchase, capital purchase, but it's not going to be upfront. What bonus depreciation does is it says, look, recognizing you're outlaying this cash today, or sometimes you're leveraging it, right, via a bank note. And on the tax side, we'll let you deduct the whole thing up front or a good chunk of it, right? So let's say you buy a $100,000 piece of equipment with a 5 year useful life. Instead of having wait 5 years, deducting 20,000 each year for 5 years, you could take the full $100,000 in that first year. So it's great on a few fronts. One, it makes it a little bit easier for accounting on the tax side, right? Because now you don't have to worry about depreciating year over year. You just took it all up front. And now it matches what you paid for the thing right out of the get-go. And then also allows you to fast track some expenses so that maybe the year in which you purchase it, the tax bills will be a lot lower. Or in some cases, it brings things down to in loss territory and you have an operating loss that can then be used, absorbed in subsequent periods for the business.
All right, so let me ask you a question on this one. So I have a business. It's coming to December. I've had a great year. Am I going out and buying a $300,000 G-Wagon and saying it's a business expense and expensing it? I mean, you're seeing it's crazy how many new car plates you saw in December and January, right?
Mhm.
Of people just buying these quote unquote business cars and then fully deducting the price, even though they're not fully paying for it at the time.
Yeah. Yeah.
So I mean, what are the restrictions there? What are you seeing kind of in that front? Because I think there's unfortunately been people that are taking advantage of this, but what is legal and what is not?
Yeah. So the first thing is it never makes sense to chase, or generally never makes sense to chase tax savings. Okay. What I mean that by that is it doesn't make any business sense personally or as a business. Because think about it, we're as taxpayers, we're all effectively our own little businesses, right? We have
Right.
income and household expenses. It doesn't make sense to pay for something for the just for the tax savings when the tax savings is going to be less than what we actually paid for it. Does it make sense to spend $100,000 to get a tax savings on a piece of equipment if if that's going to save our tax bill $30,000? Wouldn't it have been better just to pay the $30,000, right, and not have to pay the
Yeah.
100,000? So that comes up quite a bit. Now, what is appropriate or allowable when it comes to things like this is you have to remember that just because you can do it doesn't mean that you're supposed to do it or that you're following the code, right? So the bonus depreciation, as an example, has to be qualifying assets. Well, it's a qualifying asset. If that G-Wagon, $300,000 G-Wagon is for a little side hustle business of providing some sort of like obscure consulting to one client per year that pays you $8,000 a year, that $300,000 bonus depreciation item is not going to look very good when your income is only $8,000 for this business, right?
That's a
It
good
has
point.
to make sense, right?
Yeah.
And that's just not just for tangible goods or equipment, but for any business expense, right? Unless that expense is aligned and is customary and necessary for the generation of revenue of the business in question, it probably isn't deductible.
Yeah. I know it's a question that we always obviously defer to you guys. So in the planning, but we've seen some pretty creative things. R&D expenses, expenditures. This is something that a lot of our business owner clients are actually were not aware of because this applies to more than just somebody actually doing research and development. It's there are, I believe, four questions, right, that needs to be answered here. And it does apply to a lot more industries than I thought it did. Are you seeing a lot of your clients, and this is the cool thing because I think you can go back to 2022 on this where you're able to take the deduction and or the deduction and some sort of a credit. I think you can almost double dip now. But what are your thoughts on the R&D? Where are you seeing planning opportunities there for some of the business owner clients?
It's interesting with the R&D. I see it overutilized by some folks that are barely doing R&D, right? But they justify some of the things being baked into it. And then other folks that arguably they could be taking some R&D deductions and they don't know about it, like at all. They have no idea, right?
Yeah.
And you're right, there is a four-prong test that has to do with the purpose of the expense or the, whatever this research and development costs are. That's technological in nature, elimination of uncertainty, and process of experimentation, right? So there's a tech component to this, or a scientific component to this. So it's not as though someone is sitting at home and they're doing some online research and they call it research and development. That's not going to survive the sniff test.
And the cool thing though is, I don't know if you work with, but there are companies that come in and see if you qualify, and they usually take a percentage of what what they're able to kind of recover for you.
Right. And that's what most CPAs like myself will do is because that's kind of a very niche service. And it makes more sense for companies, individuals to use one of those R&D credit, study providers where, yeah, you have to pay them whatever it is, 15%, 20% of what the expected savings is, right? So you're still ahead, net net, right? But then as a CPA, then we just kind of point to this report, right? It could be pretty beefy at times, tens of pages, hundreds of pages, if you will, signed by a organization that holds itself as an expert in this type of analysis, right? Because that's all they do. So that if there is scrutiny by the IRS or any taxing authority, we could point to this documented study, and you as a taxpayer could point to us and the study.
Yeah. Thank you. I'll skip through these qualified ones. These are some of the enhancements to, um, and I'm not too familiar with these, just kind of an employer provided child care credit. There was an enhancement to those that your employer is actually able to put that in place for you and they'll get a credit. Adoption credit, dependent care credit. Oh, excuse me. And then There's going to be another slide later on the charitable contribution one, so we can come back to that. But anything here that you're seeing often, or at least you've seen in the 2025 tax year, that's applying to most folks that they should kind of, oh, I guess um, the student loan payments, but I don't have a lot of employers that actually pay for their employee student loan. I don't see that often.
Same, I don't see it much. I've had a few businesses do it, but the amount isn't substantial. It's
Right.
about 5,000 annually, but that is a really nice benefit to offer employees. They say, look, instead of giving you this additional income that's you're going to pay tax on, instead we could pay down your student loans, which you're paying anyways, which you have to pay down anyways. The employer gets the deduction, and then the individual doesn't pay any tax on it.
Yeah, no, definitely a good strategy. I just don't see it as often yet.
So
Um, 529, they just expanded the bill and added a few additional distribution and tax redistribution. So the way that the 529 works, when it was first opened, it was only for higher education, basically college and graduate school. And as they realized that not enough people, sometimes they get to a point in college where they're getting a lot of grants and scholarships, and they're not using these 529 funds that now they're stuck with a bunch of money in a 529 that is fully taxable distribution. So they are trying to do a different changes throughout the years, and now you're able to apply it to elementary and secondary school expenses. I believe there's a limit to that of ten or $20,000 a year, but
yeah,
at least now you're able to do that. A few years ago, they made the change of using it for what do they call them? Technical schools, right? Like nursing school, electrical schools, trade schools. And so that's possible. So let's say you have a 529 for your child's done with college, instead of just changing the beneficiary to your future grandchild, with, the count's going to keep growing, you can change the beneficiary to yourself and then maybe go to school afterwards. So they're making different variations, just adding a little bit more flexibility. You're also able to move on and roll over the leftover 529 into a Roth IRA. And they have that limit at 35,000, but that has to be done. If the limit is 7,000 a year, basically you're doing 7,000 a year for the next 5 years to get to 35,000. So just different things that they're trying to do at the 529 level.
You can also super fund a 529, right? Because if
Yep.
you contribute to a 529, keep in mind, kind of going back to those gift tax thresholds or exclusions, 20,000 per year. If you super fund, you could contribute up to 5 years worth of exclusions all at once, right? Just one big contribution to someone's 529 plan and be able to still leverage that exclusion that doesn't dip into your lifetime exemption.
Yep. So if I'm a husband and wife, grandma and grandfather, they want to set up a 529 for their child, which is the way that a 529, in my opinion, should be set up. There are new rules now with the FAFSA that if the 529, and the FAFSA is the federal application for student aid, when your child is about to go to college, they have to fill this out. The 529 owned by a grandparent is no longer considered an asset. And so if it's owned by the parent, it is, but if it's owned by the grandparent, it's not. So they call it the grandparent loophole that I'm sure they'll end up closing soon. But if we're grandparents, if me and my wife want to contribute to our grandkids, we each can give $100,000 in for that particular child. So 5 years at 20,000, and we could front load that 529 and then move that money out of our estate. So it's a great tool. um, the next thing on here, and I just want to be cognitive of time. So I believe this is one of the more important ones. Let me just run through real quick because, yeah, okay. So the opportunity zone, from a planning perspective, is if you're selling a house or a piece of property and you're trying to defer capital gains tax, there was a way for you to put it in an opportunity zone. So do you see a lot of opportunity zones, Jeff?
Not a lot. I have some
Okay.
business owners, they have some investment properties sitting in opportunity zones and they're just doing the the wait the 10-year thing so they could have
Got it.
capital gains
So,
free.
so the way that it worked with the Tax Cuts and Jobs Act is you were able to delay the capital gains from 2017 or 18 as the tax year to 2026. So about 5, 6 year delay, and then you would pay a portion of the tax, and then you leave the money in there, and after 10 years, basically you take those gains tax free.
Mhm.
So now that's extended, but with a little caveat is the deferral period now starts January 1st of 2027, and it extends to you don't owe any tax until 12/31 of 2033. The issue is if you end up potentially doing an opportunity zone in 2026, it's kind of a dead year. It's the 1 year that it probably wouldn't make sense because you're not deferring. You're only deferring until the end of the year. So that's just one thing to determine on opportunity zones. There's also going to be an expansion of what's considered an opportunity zone. So that's something important to note. And this is the kind of expansion structure here. Um, Anything else you want to add on this one? I know that we probably have time for one more slide just to leave some time for Q&A.
Just with opportunity zones, most of the clients that I have doing anything with it, it's usually by way of a fund. Right. So it's just another
Yeah,
investment.
yeah,
Right. But the physical aspect of opportunity zone, right? It's a defined geographical space somewhere on a map, right? Wherein something, a structure or business is put within it, it's able to appreciate potentially, right? Capital gains tax free, right? So what I mean to point out is, let's say that you are looking to invest into a physical space, right, for a business, right? You're opening up some sort of shop or business of brick and mortar, right? Or maybe it's just your operations. If for whatever reason something within an actual opportunity zone makes sense, just as much as one that is not an opportunity zone, for that reason alone, that could justify, well, no, you should probably build in the opportunity zone, right? Knowing that, especially if this is like a long-term investment, fast forward 10 years, whatever appreciation there is, and you exit this investment, this business, right? It'd be capital gains tax free.
yeah. No, definitely great opportunities. No pun intended. All right. And the last one is just for business owners that have a C Corp stock. And this was basically if you owned original stock, if your company is a C Corp and you sell it and it qualifies under certain parameters, you're able to exclude 15 million. It used to be 10, now it's $15 million in capital gains because of the qualified small business stock. And then they added some originally you had to wait the full 5 years. Now they have it where if you wait, if it's only after 3 years, you'll still get 50% of the exclusion. So we're seeing a lot of strategies with business owners on, potentially shifting to C corps, potentially doing a piece of their business to C corps. The ones that are planning to sell in the next 5 to 10 years, there's a lot of planning opportunities we're seeing there. Any thoughts on the QSBS, Jeff?
The biggest hurdle I see taxpayers or business owners going through is seeing if they even qualify from like an industry perspective, right? There's several factors that have to come into play to be qualified for QSBS treatment, like being a C Corp. But the biggest hurdle, I think, is being in the appropriate industry. So, for example, professional services like ours, accounting, law, architecture, anything like that, don't qualify, right? Hospitality industry businesses, finance businesses, farming businesses, well, it's generally not. Usually think of tech businesses, tech startups, manufacturing, those kind of enterprises that usually will be able to qualify for this.
Yeah. No, definitely. I think I've heard one CPA say it's easier to tell you what does what does qualify than what doesn't, just because there are so many industries that don't.
Yep.
But it's definitely worth looking into. All right, last one, just a few terminations of these tax credits. A bunch of them expired last year, a bunch of them expired Q1 of this year. So I think most of us are aware of these clean energy solar tax credits that expired. That concludes the slides. I know it was a lot. If anybody has any questions, we'll hang around for the next 10 minutes to answer any questions.